How to combine a wave principle and divergence part 2. In this tutorial, I want to discuss, bullish and bearish divergences that usually appear during the second Elliott wave. At the end of this tutorial, one will be able, to know exactly how to trade, divergences during the second Elliott wave. All right. The purpose of this video is to help day traders and swing traders to improve their divergence trading. What we have noticed that traders very often will screen for stocks, for commodity. We use a screening software, to find, divergence trading setups. So they may see a divergence trading setup on a weekly chart, monthly chart, hourly chart, daily chart, and they will trade it. But if one is able to combine the wave principle and the divergence, one will become a better divergence trader. Also, if one knows how to identify the first wave, second Elliott wave, one will understand more, about, divergence trading like a professional, So I recommend to traders to watch the full length of this video. In the first part of this video, I was talking about how to combine divergence, how to combine wave principle and divergence part 1. We were talking about divergences that appear during the first Elliott wave. But in the second part, which we are discussing now, I will be talking about divergences that appear during the second Elliott wave. I do not want the video to be too long. I also want to clarify with traders. As you can see on my chart, I draw some line here. I'm not using a real chart now to demonstrate this tutorial. This is the first step. As always, I want the traders to get the message first, Get the message, the knowledge first, and then we go to the drawing board to do a real-time demonstration. So this is what we are doing now. My friend, the best bullish and bearish divergence very often will appear at the end of the second wave. I think it makes sense to know where and when the best bullish and bearish divergence usually appear. It's great to know if you are a divergence trader, a swing trader, day trader, you want to know. They usually appear at the end of the second wave. So bringing us now. So when we are talking about the second Elliott wave, it's a corrective wave. But we have 13 specific Elliott wave patterns. So at this point in time, we'll be thinking it will make sense to know those 13 specific Elliott wave patterns. So we will be able to know that the second wave has ended. So if we can analyze the internal wave of the second wave, for instance, if we see a zigzag during the second Elliott wave, and we know that that pattern is completed. Not only that, we can also see a divergence at the end of the second wave. So we are able to identify, to recognize that the second wave has now ended. So this is about wave count, the recognition of the wave pattern. So we know that a pattern is now completed during the second Elliott wave. The second Elliott wave is now completed. And now we also see, for instance, RSI giving us a divergence, or the stochastic giving us a divergence warning, or MACD giving us a divergence warning. We also know that, the best divergence or valid divergences usually appear during the second Elliott wave. My friend, it's becoming a bit exciting, I don't know about you, because if you are day trading, swing trading, the best part that you want to take part in is the third Elliott wave. And the third Elliott wave will start after the divergence that we see during the second, that we see at the end of the second wave. You are about to catch the best part of the price action, which is the third Elliott wave. So if you want to know how to catch the third Elliott wave, you want to first learn and master the Elliott wave corrective wave. What are the corrective waves? You master them first, Now, you are able to recognize that the second wave, because it's a corrective wave, has ended. You look at your stochastic, you look at your MACD, you see your RSI, and the RSI, the relative strength index indicator, is flashing for us a warning, a divergence warning, at the end of the second wave. We now go to Google Finance, we perform Google Finance acid test, we check the economy news, the market environment, everything aligned beautifully. Well, we are ready to catch the third Elliott wave. For practical Elliott wave trading, what I recommend to traders, my friend, is that when the first Elliott wave is completed, please use the Fibonacci retracement tool. So first Elliott wave is completed, use Fibonacci retracement tool, okay? And then highlight the 50% and the 61.8% Fibonacci retracement level. You also notice that very often the second wave will end somewhere near the 50% and the 61.8% Fibonacci retracement level of the first wave. Now, for traders that are thinking like a scientist, it's not always the case, but very often, that's what we see. The second Elliott wave can go down up to the 78.6% of the first Elliott wave, but if the momentum is strong, it's likely to end somewhere near the 50% and the 61.8% Fibonacci retracement level of the first wave. The Elliott wave rule is that the second wave should not cancel the first wave. So it can go down, but shouldn't go beyond the beginning of the first wave, unless the fundamentals are not supporting the new trend. Remember, I don't want to talk too long. You can go to 24elliottwave.com, watch the mind games, Elliott Wave Explain, and the rest of everything else that we have said before. But for the purpose of this video, talking about how to combine wave principle and divergence part 2 during the second Elliott wave, highlight the 50%, 61.8% Fibonacci retracement level of the first wave on your chart. These are not a magic level, these are just key level you want to monitor. And now you are paying attention to the internal waves of the second wave. Is it completed? Is it finished? Great. Well, if you are not sure or you don't know anything about that, you may draw a trend line around it. Try to draw a trend line along the second wave. All right? Now, if you see also a divergence in that zone, now we will now use what we call a top-down trading method, because this is a trading setup, not a trading signal. So we may see this, for instance, on a weekly chart. So we will break it down, weekly chart, 4-hour chart, 15-minute chart. Or we may see this trading setup on a daily chart. So they set up daily chart, hourly chart for the signal, and 10-minute time frame for the entry. Or we may see this trading setup, okay, on a monthly chart. So we use monthly chart trading setup, daily chart for the signal, hourly chart for the entry, and so on and so on, okay? So the best bullish and bearish divergence very often will appear at the end of the second Elliott wave. If, for instance, we are in an uptrend, so a new uptrend is about to begin, we see the first wave, the second wave is beginning, okay? Now we see a bullish divergence at the end of the second wave, all right? If we check the fundamentals, we notice that this stock has failed the Google Finance acid test, the market environment is bearish. They say what? There's a high chance that the second wave may continue to go down and cancel the first wave, which means we have to restart counting the wave. When the second wave cancels the first wave, talking about the Elliott wave count guidelines, we will restart the wave count, because there is a violation of the Elliott wave rules. Okay? So the best divergence will take place at the end of the second wave. But for the purpose of this video, traders must first know how to recognize corrective waves, know all the Elliott wave patterns, very, very important. So you want to know when the second wave has ended, which pattern is the second wave. All right. You want to highlight the 50% and 61.8% Fibonacci retracement level of the first wave. And you want to know also how to recognize the first wave and the second wave, because if you don't know where is the first wave, where is the second wave, you will not be able, okay, to recognize the end of the second wave. All right? Very, very important. These divergences that appear during the second wave allow us to catch the longest parts of a trend, which is the third area wave. So we want to get it right, combining the technical analysis with the fundamentals. And if we get it right, we are likely to be rewarded. Sometimes you may see excellent divergence when the second area wave goes down all the way to the 78.6% Fibonacci retracement level of the first wave. The risk is low because we don't have to use too much stop loss, okay? Because it went down all the way to 78.6%, so we can just hide our stop loss 10 pips below the beginning of the first wave. As always, this is a trading setup. We must implement a multiple time frame trading method to trade it. The best bullish and bearish divergence usually will take place at the end of the second wave. All right? If there is another divergence that is appearing during a complex second wave, we can ignore that and wait for a divergence that we may see at the end of the second wave. I would like to clarify to traders that you may not see a divergence, you may not always see a divergence at the end of the second wave. Sometimes you may see a divergence. So the trick that we can use is to go now, okay, use a screening software that allow us to pinpoint divergence, okay, setup. So we may have a first list of stock or commodity or currency pair that are showing a divergence trading setup. So we look at the list. Now we want to see the best divergence. So we will now combine our divergence trading strategy with the wave principle to select the best, okay, divergences. Now remember, we will not use the technical analysis alone. We will combine the technical analysis and the fundamental. Remember, it doesn't make any sense to see a bullish divergence, all right, at the end of the second wave, but the stock or the financial instrument that you are trading, the fundamentals are weak. It doesn't make any sense. On the other hand, all right, if fundamentals are weak, we will not see any strong third area wave. It doesn't make any sense. Forget it. It's not about technical alone, all right? The same thing, all right? If we see, all right, a bearish divergence at the end of, okay, a second bearish wave, all right, we are in a downtrend, and we see now at the end of the second wave a bearish divergence. If the fundamentals are solid and the market environment is bullish, we're not going to have a third bearish wave. So we want to combine what we are learning now with the fundamental. It makes sense? It is also powerful. This is the end of the video about how to combine wave principle and divergence part 2. This video is recorded for traders that are trading divergence to help them filter out false divergence and to be able to recognize the best divergence where we have a bullish, a temporary divergence, where do we have false divergences, where do we have valid divergences. The best divergences will take place at the end of the second Elliott wave. One must always combine the technical analysis and the fundamentals. If you like this video, please give us the thumbs up. If you dislike it, please don't worry, give us the thumbs down. We want to know, all right? We want to know how many people hate this video, how many people like it, okay? So don't worry, we are still friends, okay? All right? And if you love it, feel free to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to combine wave principle and divergence part 2. I invite you now to follow me in part 3. In part 3, I will be talking about divergences that are usually taking place during the third Elliott wave. Stay tuned.